America owes over $34 trillion, and the interest meter never stops. At this scale, debt isn't a number, it's a system. In 1933, the US government made private gold ownership effectively illegal. They took the gold at $20 an ounce. Then they changed the price to $35. First, they took the hard money. Then, they changed its value. Today, the US government already holds a massive pile of Bitcoin, not by mining, by seizing. Over 200,000 Bitcoin from criminal cases. The US may be one of the world's biggest Bitcoin whales. By accident. But here's the problem. Even if Bitcoin goes to $1 million per coin, 1 million Bitcoin would only equal $1 trillion. America owes $34 trillion. So if Bitcoin can't literally pay the bill, what kind of plan could this be? April 5th, 1933. President Franklin D. Roosevelt signed Executive Order 6102. With one signature, private gold ownership became effectively illegal in the United States. America was in the middle of the Great Depression. Banks were collapsing, people were panicking, and the government was losing control. Gold was flowing out of the system as people hoarded it for safety. Roosevelt needed that gold back, so he ordered Americans to turn in their gold coins, gold bullion, and gold certificates. You had to bring your gold to a Federal Reserve Bank, and you had no choice. The penalty for refusing? Up to $10,000 in fines, or up to 10 years in prison. In 1933 dollars, that fine was a fortune. Most people complied. They handed over their gold and received $20.67 per ounce. Then came the trick. In January 1934, Roosevelt signed the Gold Reserve Act. The official price of gold was changed from $20.67 to $35 per ounce. Overnight, the government's gold was worth 69% more. The people who turned in their gold at $20 missed the entire upside. The government won. The people lost. Where is all that gold now? Fort Knox. The United States still holds over 8,000 metric tons of gold. One of the largest stockpiles on Earth, built on the gold that was taken from ordinary Americans. And this playbook from 1933 is exactly what some believe could happen again. But this time, not with gold, with Bitcoin. Fast forward to today. The United States government owes over $34 trillion. That number grows every single second. The debt to GDP ratio is now around 120%. That means America owes more than its entire economy produces in a year. This hasn't happened since World War II. But here's the number that should scare you. The interest payment on that debt is now approaching $900 billion per year. That's more than the entire military budget. The most powerful military on Earth costs less than the interest on America's credit card. So how do you pay off $34 trillion? Option 1. Raise taxes. Politically almost impossible. Option 2. Cut spending. Also politically impossible. Option 3. Print more money. That causes inflation. Option 4. Default. That would collapse the global financial system. Option 5. Something else. There is a fifth option. You don't pay off the debt. You melt it. How? Inflation. If you can devalue the dollar over time, the debt stays the same number, but becomes worth less in real terms. This is exactly what America did after World War II. The debt didn't disappear. It just became easier to pay because the dollar became weaker. And this is where Bitcoin enters the picture. Here's something most people don't know. The United States government is already one of the biggest Bitcoin holders in the world. Not because they bought it, because they seized it. Over the years, the Department of Justice has confiscated Bitcoin from criminals. Silk Road in 2013, the FTX hack in 2022, and many others. Current estimates put US government holdings at around 200,000 Bitcoin. That's worth billions of dollars. And they didn't spend a single dollar to get it. But seizures might just be the beginning. In 2024, Senator Cynthia Lummis introduced the Bitcoin Act. The proposal is simple but massive. The United States should acquire up to 1 million Bitcoin and hold it as a strategic reserve, like gold. The bill even discusses funding this purchase by revaluing gold certificates. Sound familiar? It's the 1933 playbook. Meanwhile, Wall Street is moving fast. In January 2024, the SEC approved spot Bitcoin ETFs. BlackRock, the largest asset manager on Earth, launched its Bitcoin fund. Within months, these ETFs accumulated hundreds of thousands of Bitcoin, billions of dollars flowing in every week. Bitcoin is no longer just for tech nerds and crypto bros. It's now a Wall Street product. And then there's MicroStrategy, a company led by Michael Saylor that turned itself into a Bitcoin holding machine. They've accumulated over 500,000 Bitcoin using debt and stock sales. One company now holds more Bitcoin than most countries. Do you see the pattern? The government is seizing Bitcoin. Politicians are proposing Bitcoin reserves. Wall Street is buying Bitcoin through ETFs. Corporations are hoarding Bitcoin. This is the new gold rush. And just like 1933, the big players are accumulating while they still can. But before the big players could accumulate, something had to happen first. The small players had to be shaken out. 2022. Crypto winter. It started with Terra Luna, a $40 billion collapse in a matter of days. Then, Celsius went bankrupt. Then, BlockFi. Then the biggest shock of all, FTX, one of the largest crypto exchanges in the world, gone overnight. Billions of customer funds vanished. Trust in crypto was destroyed. And what did regular people do? They panicked. They sold. They swore they would never touch crypto again. But while retail investors were running for the exits, something interesting happened. The institutions started buying. Quietly. Steadily. This is an old Wall Street game. Crash the market. Shake out the weak hands. Buy everything at a discount. In crypto, they call it the transfer from weak hands to strong hands. In 2022 and 2023, Bitcoin moved from retail wallets to institutional vaults. The little guys sold the bottom. The big guys bought it. And by 2024, those same institutions launched ETFs and invited retail back in, at much higher prices. There's a saying in crypto, not your keys, not your coins. It means if you don't hold your own Bitcoin in your own wallet, you don't really own it. Someone else does. When Bitcoin started, the whole point was freedom. You could hold your own money. No bank needed. No government permission. Just you and your private key. But something has changed. Today, more and more Bitcoin is held by exchanges, by ETFs, by custodians. BlackRock's ETF alone holds hundreds of thousands of Bitcoin. Coinbase is the custodian for most of the major ETFs. That means one company controls the keys to billions of dollars worth of Bitcoin. Bitcoin itself is decentralized, but the custody is becoming very centralized. And here's where the 1933 parallel becomes haunting. In 1933, gold was scattered. People kept it in their homes, under their beds, in personal safes. The government couldn't easily control it, so they forced everyone to bring it to the banks. In 2025, Bitcoin is following the same path. Not by force, by convenience. People are voluntarily moving their Bitcoin into ETFs and exchanges because it's easier, because it feels safer. But in doing so, they're giving up control. Just like in 1933, the asset is moving from the people to the institutions. And once it's there, the rules can change. Now let's talk about the math. The US government holds around 200,000 Bitcoin. At $100,000 per coin, that's $20 billion. The US debt is $34 trillion. $20 billion doesn't even scratch the surface. So how can Bitcoin possibly help pay off the debt? The answer is that Bitcoin doesn't pay off the debt directly. It helps melt it. Here's the strategy. Step 1. Accumulate Bitcoin as a reserve asset. Through seizures, through purchases, through ETFs flowing into American markets. Step 2. Let inflation do its work. The debt is $34 trillion. But those are just dollars. If the dollar loses purchasing power over time, the debt stays $34 trillion in name, but becomes much smaller in real value. Step 3. Hold hard assets while the dollar weakens. Gold did this for decades. Bitcoin can do it faster. Think of Bitcoin as a lifeboat. The ship is the dollar. The ship has a leak called debt. You can't fix the leak, but you can build a lifeboat. If the US holds significant Bitcoin and Bitcoin rises while the dollar falls, America stays wealthy even as the dollar weakens. The debt melts in real terms. The balance sheet stays strong because of hard assets. This is exactly what happened in 1933. Gold was collected. Gold was repriced. The dollar was devalued. Debt became easier to manage. The same playbook, different asset. Michael Saylor has said it publicly. Bitcoin is digital property. Nations should acquire it. Larry Fink of BlackRock calls Bitcoin digital gold. These aren't fringe voices. They're the most powerful players in finance, and they're all saying the same thing. So who loses? In 1933, the answer was clear. Ordinary Americans who followed the rules. They turned in their gold at $20. They watched it get repriced to $35. They lost 69% of the upside. They trusted the system, and the system changed the rules. In 2025 and beyond, the losers could be similar. People who hold only cash while inflation erodes it. People who keep their Bitcoin on exchanges and assume it's safe. People who get priced out as institutions accumulate. The pattern is always the same. The big players accumulate first. Then the rules change. Then the little guys realize too late. In 1933, the government moved gold into the system. In 2025, the market is moving Bitcoin into the system. Voluntarily. The question isn't whether Bitcoin survives. It will. The question is who controls access when it matters most. This is the hidden history of money. The same patterns, the same playbook, different generations, different assets, same outcome. Subscribe so you don't miss what comes next.